But I have an idea. They, of course, they can do, if you forecast now to July, this is a whole thing. So you have to put another 120 million up here. I mean, aggregate to the 700 billion from June. So then that would make $840 billion. And we are now at 840. So I would assume they will do up to 1 trillion in reverse repo. And then we have the Jackson Hole meeting in August coming up. And at that time point, they have to somehow, that's my assumption, they have to announce this tapering at some point, because this is not sustainable here, what we are seeing.
Welcome to another RTD interview. Today, I'm excited to have first-time guest, Mr. Oliver Reiche. He's an investment specialist, contributor on Seeking Alpha, and today he's joining us to share his thoughts on the economy, precious metals, and investment opportunities, as well as the current repo market situation. So, Oliver, welcome to RTD Interviews.
Yeah, thank you for having me on your show, Mike. I really appreciate you.
Yes, I appreciate you for taking time to join us. And so I came across some visual aids that you put up on the internet a few weeks ago, and it really caught my attention. And it received a great response from a lot of influential economists. And so I thought I would have you on directly and have you share what exactly all that means to the RTD audience. So I'm looking forward to diving into that. But before we move forward, can you give us a little bit as to who Oliver Reiche is?
Well, I've been a freelancer since 2017, so I've been dealing with the stock markets pretty much. Most of the time, especially with focus on the US stock markets. But also I care about the cryptocurrencies, everything what is blockchain related. And so I've been frequently in touch with other investors about that because they appreciate my expertise about the stock markets. And especially since I've been contributing to Seeking Alpha with my investment thesis. And so they are reaching out to me, asking me, hey, what do you think this is a good investment? Can you do a financial analysis on that? Can you check the chart if that maybe is a good entry point or exit point, or should I just stay away? And so that's how I came in touch with that. And I've been doing this since 2017. Prior to that, I was working for one of the biggest financial services firm in the world. I was pretty much working for more than 5 years in the mergers and acquisition space. So that's where I have my strong financial analysis expertise from. That makes me, capable to read and understand the financial statements.
Okay. Well, Zion, thank you. I appreciate you for sharing that. And so I want to dive right in. And so on my side, as I mentioned, my channel focuses primarily on surface topics. I don't really dive too deep. Yeah. Sometimes some subjects are beyond my expertise. And so I'm looking forward to having you share those visual aids with us. But before we arrive to that point, I talk about the fact that the monetary system is currently having some issues, and we're witnessing the piping system of this current monetary paradigm go through some changes. And I think it has a lot to do with the whole the repo market as well as the reverse repo market. But before we get into the reverse repo market, give us a little bit of the repo market and what actually probably, in your estimations, took place back in 2019. When QE, not QE, officially started. Give us a little bit of what that was all about and how it got us to this point here, if you don't mind.
Yeah. So before September 2019, when the repo was breaking out, the repo issues everyone was suddenly paying attention to, we had the inverted yield curve, if you maybe remember that. So that means that everyone was freaking out that we are turning now into recession. And it's exactly a month later when this inverted yield curve thing happened, we had the repo crisis coming up. That means there was an illiquid market suddenly in the banking system, in the financial system. So there were some really structural issues in the financial system. And the Fed solved this, let's say, they couldn't do QE at that time. So they used a repo to pump up the financial system with with money by buying bonds and giving them liquidity for the bonds they are buying. And this is pretty much repo from the one side. And as we are talking also about the reverse repo today, reverse repo is exactly the opposite of that. So the Fed here is taking money out of the financials or the financial market by selling these treasuries they just bought from the other side, from the banks usually, and then yeah, they're draining the liquidity out of the market. This has something to do with the QE they are doing right now, or they have been doing since pretty much 2020 with the breakout of the coronavirus.
So if I might, ask, so as a result of what happened in September 2019, does that have anything to do, I'm assuming it has to, but with the quantitative tightening? So they went through several months beforehand of trying to tighten. They told the world that they could draw that stuff back and reduce some of the balance sheet, but obviously something didn't go too well with that tightening, I assume.
You're absolutely right, Mike, because it has really something with the tightening that they have been running back in 2018, 2019. At some point, they couldn't do this more. I think it was in 2018 when we had this December plunge. Yeah, they completely reversed the policy. The Federal Reserve, back in the days, they said they have to rate hike more times in 2019, and suddenly after the plunge, they completely changed their policy, and they started to say, okay, we stop, with the hike rates or rating hikes, and then we stop it for a while, and then suddenly, because of the tightening policy, the inverted yield curve happened in 2019, August it was, I think, or July. And that was the trigger point for, let's say, everyone in Washington, especially the US government, and worry Trump at that time, what's going on, why we are not cutting the rates, why we have this inverted yield curve happening. We have to get back to the quantitative easing. And that was creating the turmoil that time, or let's say not turmoil, but I would say some.
I would say there was some glitches in the system. That's what I would use. I'll say there's some glitches in the system that they foresaw or did not foresee and had to reverse course probably.
Yeah, the financials, they were feeling very uncomfortable. Yeah, they were very uncomfortable about the entire situation. And everyone was aware what this inverted yield curve means, because it usually indicates there's a recession coming in the US.
Mm-hmm. So okay. So with the inverted yield curve that they were trying to counter by the whole whole repo market that picked up from that point on, it was not QE. I remember Jerome Powell downplayed it, saying that they kept it hush, basically. Only the people in the alternative media talked about it. And sure enough, was it 4 or 5 months later, we had an event in the form of a health situation. How coincidental was that? But so let's get into the whole. No, go ahead. I'm sorry. Go ahead.
No, exactly. I mean, you pointed already out. I mean, this is like a coincidence when we had this coronavirus breaking out exactly throughout the time when they just started with repo. And they understood that there are more issues in the financial system. So they had to come up with more QE. Repo was not enough. And then through a wonder, this coronavirus broke out. And in March, I mean, everyone knows they have been starting with a never seen liquidity program. I mean, a massive QE program with bond buying of up to 120 billion per month. And then they kept away, or they could ignore the repo at all, because they changed officially to QE. Back in the days, like you said at the very beginning, this is not QE when they started with repo, but then officially they started with repo in March 2020 last year. And with QE.
Yeah. So here we are now. It's been approximately 400 or so days, a year and a month or two of unprecedented monetary policy, or the monthly acquisition of 120 billion worth of assets. Which I'm curious to get your thoughts on. Are those really assets, given the fact that who's going to be able to purchase those things, and will they be able to withdraw those funds? Where's the Federal Reserve's balance sheets heading, in your opinion, with all this quantitative easing?
Yeah, I mean, they look a year ago, before the coronavirus broke out, or let's say with the repo crisis, when it started to break out in 2019, in September it was. I made a note about that. So the balance sheet of the Federal Reserve was at that time at 3.8 trillion. So now, fast forward 2 years almost later, we are now at $8.1 trillion. So it's more than 113% increase, in assets on the balance sheet of the Federal Reserve. That tells you everything. The sums are getting bigger and bigger. And this has something to do with the inflation we are currently facing. But this would be another, topic thereafter.
Yeah. So
That's
let's
it.
dive. So let's actually just dive into, here we are now, a year plus, give or take, a year and a half later. All the funds have been, the reserves have been created. They come up with QE, stimulus checks, stimulus programs, everything that they try to come up with is out here now. And I assume the now that you said they're withdrawing it with the reverse repo. So let's dive into the visual aids that you've prepared and walk us through it and give us some time frames and educate the audience a little bit.
So before I tell you what's going on in this chart that I put together, let me say that since 2020, March 2020, last year, the QE started. So the Fed pretty much pumped as much as liquidity into the financial system as they can. In other words, they set the rates to zero almost, so the short-term rates. And they started a QE officially with bond buying up to 120 billion per month. So, and that of course led to distortions in the markets because we see everything just going through the roof. Market was making all-time highs, even though the economy was down or there was a lockdown existing all over the world even. And we were all wondering, how is it that the markets are making new all-time highs when the economy is down and no one is really producing more stuff? and so that is the let's say, history of this diagram here. And because of the much liquidity the Fed pumped, we had, of course, inflation signs showing up in form of the CPI, that is measuring the consumer purchase index, and then, of course, in form of the producer price index. And all of them increased heavily over the last few months, especially in 2021. Now everyone, when they are going to the grocery or want to buy a car, or they want to fill their gas up with the car, or they want to go anywhere with the car and they have to fill the gas, they are feeling that it is, more pricey right now. This has to do something with the inflation that is currently going on, because they pump so much money into the markets, but for less goods, or let's say for the same goods and services we have. So this is causing the inflation. You have more demand for less supply, or for the same level of supply. So, and because everything was really very intense by March or by April this year, in form of, you have seen or read in the media about lumber prices or some other commodities that suddenly had an increase by almost 1,000% or even more. And then you see Bitcoin or other cryptocurrencies really skyrocketing, and everyone was wondering, oh my God, is this inflation getting out of control right now? How can we stop this? And through a miracle, since April, lumber prices and some other certain commodities have come down a lot. And we were all wondering, how could this happen, even though they did not change their course? They are still running QE like it has never changed. They even had last week an FOMC meeting, and they stated that everything will be, pretty on course. We are good to go. Maybe we can, do the tightening by end of 2020, 2022, or definitely in 2023. They were thinking about to do the tightening, but there was no word that they really do the tightening right now. Yeah. And so everything is just going, and but in the background, and this is what the chart, why I put this together. In the background, the big elephant in the room, I call this. Something is going on, and this is how I believe they solved this inflation issue, to solve a little bit or to buffer. So if you see, for example, in the upper graph, starting with March 2021, this year, we had in the reverse repo market 11 billion showing up as a very small number, and no one was paying attention. And by the way, me neither. Because, and one more thing, first, I did not understand what reverse repo was. I knew what repo is, But when reverse repo was showing up, I had to learn that this is not putting money or bringing money into the market. It's draining, sucking money out of the market.
Yeah.
So I was seeing this number and I thought, okay, they're pumping again up the market. and then I was not following this chart, or let's say the numbers very much, up to a point where it was very unusual. It started here in May, or in May. You see here at the beginning of the month, we had first time more than 11 billion, and we had up to 100 billion.
Yeah. So Oliver, real quick, let me say. So I see here that this is a incremental growth over time, and
Yes.
it really peaked. So go back to that March timeframe, March 30th, where it looked like it was attempting to. The daily volume was extremely high. Then it dropped off. And then basically from April 1st onward is where there's been a continuation and an increase on what looks like a day-to-day amount of reverse repo activity happening there. So walk us through that a little bit, because it's growing, and where's it heading?
So you see that pretty much in March it started, and now just recently, I mean, this is the last recorded date from yesterday, so June, end of June almost, we have now 814 billion of dollars in the reverse repo. That means banks are, giving the money to the Federal Reserve overnight just to get rid of the whole money, because it's killing their balance sheet. And they have really big issues right now with the whole of the liquidity that is in the financial system. And that is, by the way, creating the inflation. And so when they dropped, you can see here that it was really picking up in March. And then now we have an unbelievable 814 billion of dollars in reverse repo. And then the chart, sometimes it's more helpful to see how it really, contributed to each other. And then, so I had the idea, okay, when I show people how the reverse repo market just started in March and is now by today, how it developed over time, maybe they want to understand what is why they are doing this, what is the reason for that, and then I put this in relation to the QE program they are doing on a monthly basis. So I said, okay, just focus on 2021. And start with January. And then you see the graph below here. And so here I say, okay, they start with 120 billion in QE in January, but still haven't started with the repo you see up here. It started in March. And so they have 120 billion, and so it's 100% in total. And then for February, it's the same situation, because the reverse repo started actually in March. But in March then, and this is why here I was dotting this on the very last day on March. Here we had $134 billion versus the QE in total aggregated of $360 billion. So 120 plus 120 plus 120. And then you come up with 360 billion. So every month they're pretty much providing a liquidity of 120 billion, and this is aggregated then by March 360 billion.
Okay.
So, and I was saying, okay, so in March we had a reverse repo of 134 billion dollars. So I was putting this into relation, and then I said, okay, or I saw that 27% has been sucked out of the financials through this reverse repo thing, but 73% is still existing in QE. So pretty much not yet undone the QE that they have pumped so far in the market. But then you see it started to pick up. Yeah, like the chart. It's going really almost in a high degree here, 45 degrees up, incremental. And here you see then that the relation is getting tighter. So first it was just 27%, then you see 28% with 183 billion. And then suddenly the big jump in May. You see from 28 to 44. So it was almost eliminating the entire QE up to that date, or to that month here, May. Yeah. And now we are in June, and this is year to date. That means till yesterday. I think today there will be new numbers coming. But as you see now, we have more reverse repo than QE actually. So we have completely undone QE for 2021. it is even said now to your question, where this all will be ending. I don't have the answer, to be honest. I look, everyone is facing the situation for the very first time. I was talking to other experts and to other friends in the investor scene. No one has the answer, but I have an idea. They, of course, they can do, if you forecast now to July, this is a whole thing. So you have to put another 120 million up here. I mean, aggregate to the 700 billion from June. So then that would make $840 billion. And we are now at 814. So I would assume they will do up to 1 trillion in reverse repo. And then we have the Jackson Hole meeting in August coming up. And at that time point, they have to somehow, that's my assumption, they have to announce this tapering at some point, because this is not sustainable here, what we are seeing. I mean, imagine the sums are moving around almost every day. This year is on a monthly basis, but the reverse repo is on a daily basis.
Right. So so in your estimation, what type of taper would you suggest, or what might we see? They'll dial back, cut back on 80 billion in was it treasuries and 40 billion in mortgage-backed securities. And then the question would be, why are they supporting the mortgage industry by buying those mortgage-backed securities at a time where the mortgage industry, according to the numbers, is doing so well? So what do you think? What type of trimming will you see them actually doing?
Yeah, I mean, for me, one of the reasons could be that the amounts or the QE is so much, and as you see that the US government, they are not really collecting money from the tax revenues. So they have more deficit spending. I mean, the tax revenues is not more covering all those spendings the government has, especially with all the unemployment aid and so on that is currently running still hot. And so because of that, when they would announce a tapering right now, it would blow up the whole system, because then they have to increase the short-term rates at some point. But we have so much debt. I mean, I was looking up, the most recent number is we have 28.1 trillion in debt in the US. And when you have to pay interest on that, you can imagine how much extra effort that would take just to come up to come up with those interest payments. Yeah, I mean, this is additionally on the debt then. So this is about to blow up, and that's why when you see also now that there's an infrastructure bill going on of up to 6 trillion that is currently looming. I mean, if this is, my assumption is they want to wait for the infrastructure bill to pass, and then they announce this QE. I mean, to end the QE and do the tapering. So
it sounds like no matter what, they're stuck. They by them open up this, as I say, cut on the monetary spigot of providing liquidity to prop up the banking sector, might I add. I always talk about that. This is all about the banking structure and all the financial products and derivatives and all the things they put out there. All this liquidity is designed to make sure that stuff stays liquid, because if the well dries up, the game is over with, I'd assume.
Yes, exactly. I mean, the party is over, like you said. As long as there is enough liquidity and you assure the investors that there will be still liquidity in the markets, they are all happy and the party goes on. But there's a moment, I mean, we have seen this last week when there was the FOMC meeting. First, Powell, the chairman of the Federal Reserve, he assured investors and the markets that we will stay on our course. And we won't change anything. Maybe we can consider about to do a rate hike at the beginning of 2023. But then 2 days later, there was another Fed board member coming up in the mainstream. And I think he had an interview on CNBC, and he said that maybe a rate hike would be better if we do this earlier than expected. And he came up with the idea to do this in 2022. And the markets immediately started to go down because of the fear that there could be a tapering now looming, I mean, very around the corner. And so you get an idea what this would mean the moment they do the tapering.
Right.
So let's crash.
Okay, so let's keep moving forward, because I'm sure that the equities market plays into this as well. So share with us a little bit of how this all correlates and the asset price inflation that we're seeing as well, if you don't mind.
Yeah, so let me pull up another chart that I put together. And this is something, because one of my investors, he was wondering why we suddenly have big tech rising again. I mean, the Nasdaq is making new all-time highs, and no one really understands why. Is there maybe a fourth wave coming, so that they have to, lock down the entire country again?
Yeah.
We don't know, but what I see from this graph, so I put together two time series, both of them dating back to the beginning of this year, pretty much in January. So you see that the orange line represents the 10-year rate. And then the blue line represents the reverse repo amounts that we just, figured out in the previous graph, how much it accumulated or aggregated over time. So what you see here, when it started to pick up in March, so the reverse repo line here, we saw that the rates were pretty much still on the sideline here. But then when the amounts got bigger, especially when we crossed this 500 billion level here, then suddenly the rates, they were coming down, and we have a diversion here. I mean, they crossed, yeah, they did a crossover here, and now we have higher reverse repo, and the 10-year rates are just sinking, or they are just crashing. And everyone is wondering, how can this happen when we have an inflation going on? And I believe this is the big elephant in the room here, the reverse repo, because this is pushing the stock market again higher.
So the goal is,
that would be my assumption, because this is what I can see, and it would make sense because, like we said, with reverse repo, the Federal Reserve is sucking money or liquidity out of the market. So they are selling the treasuries. And when you are selling your treasuries, the rates usually go down. And so it makes more the investors to take risk on in the equity market. So they're jumping into growth again, into growth stocks like Amazon, Facebook, Apple.
Yeah. So the goal ultimately is to keep, and I use the word, the illusionary net worth effect of like everyone's portfolios as far as the inflated asset prices, with housing prices, your stock portfolio and stuff like that is going up continuously, providing that false sense of comfort and cushion that everything is going good. It plays into the whole recovery narrative, because look at your portfolio, look at everything is good, and it can't be any worse. It can't be even better than this. But under the surface, as you're pointing out here, the reverse repo market, it might be that the fuse was lit and literally the wick is burning, and this might lead to some type of explosion, what you're saying.
Absolutely. And I tell you one more time, this is for me the big elephant in the room here. No one is really speaking about, because it's really hard to understand the reverse repo thing. Yeah, because everyone is so much focused on the QE, the bond buying program, and then the 10-year rates, but no one is really looking behind how is it impacting, where is the driver coming from, that suddenly the rates are going down, the 10-year rates. When we have CPI numbers that are higher than usual, the inflation. So usually the 10-year rate should go up when we have inflation going on.
Right. Okay. Well, let's keep moving right along. So you shared with us the problem, and the problem is clearly that the piping is burst. You broke it down as to what that is, and it's something we've never experienced before. So we're in it for the first time now. And so here we are. That's a major problem. Let's talk about some of the strategies and solutions that people can probably take to avoid some of the damages that will be done or passed down that will probably be generational, to say the least. But here we are. We're in the midst of a crisis. What are some things that people can do? Let's talk about some solutions. What are some things you're keeping an eye on?
Well, they should keep an eye on gold price and silver prices, and of course on the US dollar. The US dollar is also another indicator if the more trouble is ahead. If more quantitative easers are coming through the devaluation, or if the dollar is keep straining, gaining strain again. And this is what they have to look for. The gold price, the silver price, and the US dollar, how the indice is performing. And then, of course, they have to keep an eye on the big tech names, like I call this Apple, Amazon, Netflix, Microsoft, you name it. The big tech names.
The FANG stocks, the FANG stocks. Yeah.
Some say FANG man. They have to keep an eye on the FANG stock, the gold price, and of course the US dollar, and probably some other, let's say, asset classes. I would call it asset classes like Bitcoin and Ethereum. prices, because this is somehow a new game for, let's say, the millennials or the younger guys. Instead of buying gold and silver, they are more into cryptocurrencies, and you can also see from that price development if something unusual is coming around the corner or is around the corner. And we have seen this at the beginning of the year when inflation was showing up. Bitcoin and other cryptocurrencies were going through the roof.
Yeah. So as we get ready to draw towards the end of the discussion, you laid out a good explanation and possibility of what we're up against when it comes to the reverse repo market and the trouble that probably lies ahead with that, because there's no undoing any of that they've created. And so I'm curious to get your thoughts on, you mentioned Bitcoin as an option. So here on RTD, we're heavy precious metals enthusiasts. Some people dip and dabble with the BTC space, some others don't. What are your thoughts on the El Salvador movement? Is that something that will be positive, or could that, what are your thoughts on that?
I mean, it's a positive. Of course, it's good news for the crypto scene, because now it's rewarded that someone, a nation, a country, is officially accepting Bitcoin payment and the transaction of that as a legal tender.
Yeah.
This is, of course, a positive thing, but put this in relation to other big countries in the world. So we have China. They're pretty much blocking now Bitcoin mining. I mean, they're cracking down on that over there. And China is the biggest economy in the world with the US. So, and El Salvador is, this piece of little country. I mean, nothing against, I don't want to discriminate a country, but it's in relation to China really is a very low number and a small number. So it's a positive thing for the cryptocurrency market, but we should, be humble about that. We have to see some more bigger names stepping up, like, for example, a big country from Europe or from the US. I mean, or in North America. I mean, not especially the US. But a bigger player has to come up and step up and also provide Bitcoin as legal tender. And then we know that something is really going on behind the scene. I just wanted to say one thing, because today I read the news that Andreessen Horowitz came up with the news that he is launching a crypto fund of up to $2.2 billion. And this is big news. Just for your audience, Andreessen Horowitz, they were the very early stage investors into the crypto scene, so they know what's going on. And when they come up with a 2.2 billion crypto fund, this is big news for cryptocurrency, and it will have definitely an impact. The same like MicroStrategy, when they have more and more Bitcoin on their balance sheet right now to buy. But this is something that came just today up, and it's very positive news for the crypto scene.
Well, thank you for bringing that to our attention. And definitely, I think a part of the whole Bitcoin and cryptocurrency movement in general was always waiting to that for the turning point, which was institutional adoption. And clearly that is a big move towards that. So we'll see where it plays out at. I myself, I've been watching the space for quite some time, and I've seen a transition from a disruptive movement. Let's undo the banks, let's undo governments, to now it's like, let's wait for governments, let's wait for regulation, let's wait for institutions so that we can make it official. And I'm like, it rubbed me wrong, because I thought it was meant to provide freedom, not comply with the current regulation structure and monetary structure, ask for permission to unbank ourselves. So I was like, I'm more of a skeptic these days, but I do pay attention to it. So but I definitely would love to have you on later on and have you share your thoughts. But as we get ready to close up, point people back to where they can find more of your work or whatnot, and tune into what you have going on.
Well, right now I'm having a profile on Twitter, and then you can also find me on Seeking Alpha. Just Google my name up, and then you will see that I'm a publisher over there. But more, you can get up-to-date news on my Twitter account, and I'm currently building up also a website where I will provide some investment-related services. So, and newsletter, people could subscribe to my service.
Okay, sounds good. Well, Oliver, once again, it's been great having RTD. Appreciate you for giving us that in-depth analysis as to the repo market and how it's the elephant in the room that not too many people understand, but the visual aids do a good job of giving us insight as to what's underway and what's coming. So once again, thanks for joining us, RTD Interviews.
Thank you very much, Mike.